Hello and welcome to the Professional Insight Podcast, Season 6. My name is Brandon Curry. Thank you very much for tuning in.
I'm Josh Bond.
And Trevor Lindy.
And we are proud to have this man back on the podcast. The man, the myth, the legend, the infamous Dr. James Thorne, a.k.a. Dr. J. We've been following you quite frequently
We like what you got
on
to
social
say.
media, and on what you have to say about the Bank of Canada. And we've been back and forth the last couple of weeks to, get you on the podcast, and here we are. So let's you have the floor and just your thoughts on the last couple of months and the hold by the Bank of Canada, the Fed, and the state, and then we'll be getting into other questions because we've got some pretty good commentary. So
Okay.
go ahead, floor is yours.
So central bankers live in the past. One, they look at lagging data. Two, they are fearful of repeating what a guy named Arthur Burns did in the 1970s, where he cut too soon and inflation spiked. But that spike was caused by the Iranian Revolution. It wasn't caused by any demand. Okay, so we've got central bankers that we know are going to be late. Okay, they're going to ensure that inflation goes below 2% and interest rates are going to go below 2% heading into 25. The narrative in Main Street and Bay Street, shall I say Wall Street, the smart money, is that look, when you look at economic data, what people are now recognizing, and the evidence is stark, is the fact that the economic growth that everybody is seeing is caused by wartime-like fiscal policy, right? Debt to GDP is at World War II levels. So everybody is now, the narrative on Wall Street is, look, I mean, the Fed's making a mistake because they're keeping rates tight when the private sector is contracting, right? And all this data that's coming out that you hear on mainstream media and everybody coming out and not doing any work on it is really caused by $1 trillion of fiscal policy debt, which is not interest rate sensitive. So what you have is the private sector is contracting in Canada and the United States. And you have the public sector sending false signals. And you have the data is now starting to get basically, you can't ignore it. So let's go back to, and I'm going to just focus on Powell more than Macklin for the time being, because, the argument is, do we have an independent monetary policy up here? So let's just put that over here on the side. He looks at core PCE. That's the number that he looks at and the Fed looks at. And in December, he said at the Q&A that we're going to cut before core PCE gets to 2%, right? Because monetary policy or interest rates works through the economy in what they call long and variable lags. So if he cuts now, it's going to take at least a year for it to be felt. Okay, so we are still feeling the rate hikes, the effects of the rate hikes as we speak. If you just pull the data and look at an Excel spreadsheet, okay, what he knows is that, look, if you look at the data, we're about to lap 5 months of extremely high month over month core PCE in the United States. And if we just plug in the average over the last 3 months, by June, core PCE for 12 months is about 1.65, which is below the target of 2.
So core PCE, can you just let our listeners know PCE stands for?
Personal consumption expenditures. And what it was created for was it was created for not to use, and core is you take out food and you take out energy. Okay. And it was developed after the 1980s because of the fact and it's not used up here, it's used down there, because what Volcker, the big mistake that Volcker made was gunning mortgage rates back in the late 1970s, early 1980s, and it showed up in CPI numbers, which is exactly what's happening in Canada, right? But for whatever reason, we use the BS number, the old number, which I could go on ad nauseum about that. So he says basically, so when we're sitting there and you're looking at it, he said, so if you believe that's the case, then what happens is, and what the credit markets are doing, they're starting to ignore the Fed. Because if you're the credit market and the Bank of Canada and the Fed live in the past, and you guys are managing bond portfolios, well, you're managing in the future. You're an investor, right? And you've got a kid coming out of school with an Excel spreadsheet going, hey, Josh, all we got to do is hit this rate at 0.17, and we're at 6.5 by June. They're going to cut, right? And Powell says this on his Q&A. He doesn't need to see any more deterioration. He just needs to see more of the same. He's not focusing on the Q&A. He says he's not focusing on labor anymore. He's not focusing on GDP anymore, which gives you code that he gets that all these economic numbers are faulty because of Joe Biden's excessive fiscal policy. So the question is when do they cut? And the reason why they have to cut is not because of inflation. And this is what happened in 06, 07. The real risk in all of this is financial stability. It's another financial crisis, right? You're seeing it with community banks blowing up in the United States. You're seeing it with commercial real estate being written down by banks around the world. Not yet Canadian banks. I wonder if Canadian banks have exposure to the U.S. commercial real estate market. Right? So look at China. China is in deflation. The second largest economy is dealing with the largest property bubble ever.
That was Evergreen, wasn't it? It was Evergreen that blew up.
Evergreen, all the property developers in China, I've read, I mean, this is Kyle Bass basically saying this, is look, they're all bankrupt. They're all insolvent, right? And let's say it's 55 trillion. I pick a number. We don't know because it's not transparent. But let's say it's 50 trillion. And you write off 20%, right? That's 50 times 20, that's 10 trillion. The global financial crisis was 1.8T in 08. That's what we're looking at, guys.
What do you say about China's government starting to make some moves to strengthen their economy?
So
Smoke and mirrors, or
2006, Ben Bernanke said there wasn't going to be, the subprime crisis was contained. It started to unravel. He cut rates down and it still blew up. The risk is once you light the fuse. Well, let me go. We were talking about this just before we came on. If the New York Community Bank is flying into the side of the mountain, and you and I are sitting there with a bunch of cash, we're waiting for it to go to zero. Why would we step in? We buy it at zero. You buy a commercial real estate property at zero. You've got liquidity. Why would you step in and fall? And so this is the problem these guys in the central banks don't get. Once this thing starts rolling and you get deflation in these assets and you have liquidity and you've got dry powder, you wait for the plane to hit the side of the mountain as an acronym. You're like,
100%.
Yeah.
And that's what they do. And that's what we're doing. And so what they do is they wait too long. So hypothetically, they're going to wait too long. Right? We're going to get that. And this is why I've been, banging pots and pans, right? Once this thing goes down, who's going to come in? Why would you? Why would you buy a house that's been on the market for $3 million when basically it goes into receivership? And if you let it wind down, you're going to wait till it hits bottom. Why would you wait? And so then you hit the air pocket, right? And rate cuts don't do anything. So what you're going to start to see, and you're starting to see it, Yellen's talking about it, right? Is you're going to start to see they have to stop focusing on inflation. It's over. And start focusing on financial stability and the fact that if they don't nip this in the bud, right? There's problems. So this is exactly what happened with the peso crisis and the South American crisis in the 1980s. This is exactly what happened when Hong Kong blew up in 1997. It took a year later and it almost wiped out Wall Street in the long-term capital mess. right? This is exactly what happened in 08. So when you and I have been talking, or you follow me on social media, I lived it in the States, right? Once this thing gets lit, it is juvenile to think that cutting 50 basis points is going to stop this once the train leaves the station.
Sure. It's a snowball, right?
It's a snowball. So everybody else who's sitting on cash, we're just going to wait for it to we're going to hit the side of the mountain. And then we're going to go in there and we're going to buy all these properties and all these banks, and we're going to set ourselves up for the cycle. And that's what happens. And that's what we're getting into. And the point I'm trying to make as I come back home to Canada is, guys, you guys missed the last round. Right? You guys are ground zero this time around, man. You're not missing it. You're not missing one at all. Sorry.
So there's two questions that I have.
Yeah.
The first is how widespread do you think? I mean, because the one thing here's the thing. So not only a lot of people don't follow politics, and I know you do. So you'll see where I'm going to go down this yellow brick road here for a second. Not only is China dealing with a financial crisis right now, which my question to you will be, how widespread do you think it's going to be versus the U.S. is in 07, 08? But my second thing is, they're dealing with a massive population crisis right now. They are in massive population decline. Mm-hmm. The most conservative estimates, if you believe the People's Communist Party of China, which you shouldn't, but if you do, at 1.2 billion, they've already admitted to overcounting 100 million people in that count. But if you're to go on that $1.2 billion people number, they conservatively expect China's population to be cut in half within the next 25 years. Mm-hmm. So you don't even have the population to recover from a massive financial crisis, unlike the US, Canada, Mexico, which are, think of maybe not necessarily an upside down pyramid, but let's just say maybe an hourglass. So, and
it's the one child decision though, right?
It's directly correlated to the one child decision for sure that ended in 2013. But my question, Dr. J, and you've spoken about this, what's the impact globally?
So China was one third of economic growth in the world. So that slows down. It disproportionately hurts Canada because we benefited from their urbanization, the debt-fueled property bubble in the United States, building these towns that nobody goes to, and the infrastructure, right? So, So if you use the Japanese file or the model coming out of the late 80s, right? China basically needs time to grind through this, right? So China, let's say China doesn't blow up, but China needs a decade to basically grow and change. We're talking about big things, big structural changes. And to help it, and this is where the nuance comes. And I was on a podcast in the States yesterday or day before, I can't remember. They know this, right? The United States, and I'm just going to simplify it down. The United States is the central bank of the world. And when the United States aggressively raises rates, there typically has been a financial crisis that has started outside of the United States and worked its way back in. In the 1980s, it was the peso crisis, right? And what happened was South America and Mexico blew up, and guys, all the Canadian banks had exposure to it, and they had to write down book. Okay. And then in the 1997, you had Hong Kong. Right. So and so there's papers, and they've been presented at Jackson Hole. These individuals have looked at it. And so the risk has always been when the United States aggressively raised rates, and let's say Tiff Macklin and Bank of Canada had to follow because we don't have an independent policy, that put on the table that basically a financial crisis coming out of the outside of the United States, and China was the poster child for this. And we have been talking about China and the possibility of a financial crisis emulating from China, Brandon, since 2010 for the reasons that you were talking about. So the hardest part about macro is not identifying the event. It's identifying the timing of the event. And, you know, right now we need, if we were sitting around the FOMC right now, I would be saying, guys, we got to start cutting, right? We got a little problem here. But if China blows, that's going to have global ramifications, right?
Now, when you're saying cutting, are you talking cutting rates or cutting?
Yes, cutting rates, and they've got to start. So
tightening up fiscal policy.
Right. So the argument is if cooler heads prevail, then what we are here between now and the end of 25 is in the front of a global reflation cycle. Right? They need to cut rates and increase money supplies, and that's what we're seeing with China right now, right? And Japan didn't follow the Americans, right? During COVID, they didn't raise rates, and guess what? Inflation's below 2%. Why? Demographics, those long-term deflationary forces still exist, and they exist in North America and in the West as well, right? So the risk has always been going back to deflation and secular stagnation, which is exactly what happened after World War II. It's exactly what happened after World War I and the Spanish flu, right? In 1920, it was called the Forgotten Depression, right? So every time we have one of these events where there's an inflation shock, the central bankers think that inflation is going to be here, and they go too far. They look at lagging data. And then what happens is they tighten too much. And then what happens is we move into this next sector where economic growth drastically slows and deflationary forces take hold. And when they take hold, cutting rates doesn't do anything, right? Go back to the way it was before COVID, right?
What are the odds that they're wise to it before, Doc? Like, what are the odds that they're gonna navigate this thing properly?
Well, it's a big question, right?
Yeah, it's a
Josh,
huge question.
because if you sit there, and so I would always been, look, so the argument had always been to get out of this debt before even COVID hit. The way you get out of it is the way you got out of it after World War II, which was you grew your way out of it. Like nominal GDP grew faster than interest rates and inflation. So that what you're doing is you're really not contracting the level of debt. You're just nominal GDP is dividing into it. And so you go from 130% GDP, debt to GDP in 1945 to 35 in 1970, but you're not really cutting debt. You're growing nominal GDP, right? We grow our way out of it. Yeah. And that's what we got to do. And I thought that, okay, if we're going to have a crisis, let's get Fed funds rate in the Bank of Canada rate to 2.5 to give us powder dry. Let's see if we can get this thing done so that we escape deflation and secular stagnation. And that's what they had as of July 2022. And then they went on this, they went on this, basically this holy march to go up to, like in the Fed now it's up 530, right? Real rates in the United States are like 330. When inflation is at 2% in their forecast, it's 50 basis points. They've got so much to cut. It isn't funny. So the question I always say is, do they want to basically fly this? You know, we've got a global economy hooked on debt that needs to be refinanced. And if it's get refinanced at 5%, there's nothing left, guys. I mean, interest rates on the US debt right now is 1.3 trillion, which is that is bigger than the defense budget. If they don't stop, it's going to get bigger than the defense budget and healthcare. Right. And then it's going to, so the math, if you just stand back and get away from the noise, the math doesn't work. And the only way you get out of this is you cut rates and you grow. And the only problem we have with that is in the 40s, what happened after World War II is you had a dramatic decline in fiscal policy. Right. And to do that, then that's where you got interest rates. That's where you got prices below zero for a couple of years, and growth came down. The fiscal path that we're on right now in Canada and the United States is unsustainable. that bridge will be crossed. We either start it now. If the longer we wait, the more painful it's going to be. And so it's basic math. So yeah, they're going to have to cut rates. Inflation is not the problem. And if they don't get rates down, you're going to have banks having to cut their exposure to commercial real estate. That's why the banks aren't lending in Canada and the United States. That's why construction is stopped. I mean, yeah, construction's work. If you're a construction worker that's building a bridge for the TTC, right? Or you're laying track for the TTC, you're great. But if you're in construction and you're building an apartment building that needs lines of credit, that line's just been pulled. We were talking to a client today. I can't remember. I've been talking to so many of them, who runs a very important company that is tied to the construction industry. Business is stopped. So this is like driving an engine and we didn't put oil, or we got an oil change and the kid that did the oil change didn't put the plug in at the bottom of the engine, and we're driving down the parkway or we're driving on the Gardiner and all of a sudden the engine seizes. That's what we're doing. That's exactly what's going to happen. And so the question, and this is a tiring question, is that you go through all the logic and then you sit there and go, why doesn't Tiff Macklin know this? Right?
I was just thinking that exact. I was just
well, it's not my job. I'm not. It's not my job. Like, has he done the basic? Has Tiff Macklin got his PhD from Western Ontario, which is a University of Western Ontario, which is a wonderful university. It's a great program. There's no way he got a PhD and not go read the same. This is chapter 19 of Hall and Taylor in the advanced macro textbook. Okay. What we're dealing with and what he's doing wrong is what's called policy-induced inflation. Inflation that's caused by the government or inflation that's caused by the Bank of Canada. And guys, if you control for policy-induced inflation in Canada, 6 months, CPI, negative 2%. So tell me what he's doing. I don't know what he's doing.
Is it because it's ego? Is it ego then? Because he wants to, he's like, this is the hill that I'm going to die on because I'm going to look like an idiot if I about face. I mean, Trevor and I have talked about this quite in depth, and we both feel that it's ego that's driving this, that he is just so too proud to admit that, hey, I missed the mark on this one.
That's a fair point. I mean, John Crow, who was the head of the Bank of Canada in the late 80s, that's what he did. But eventually you cross the Rubicon, right? Eventually it's going to have to be reversed. So this is why I say to people, and it gets like, so I'm Canadian, right? Fine. I brought here, I live in Toronto, grew up in Scarborough, fine. But I say to people, why do you want to have your RRSP or any exposure to Canada with this going on? I mean, at least in the United States, you have a diversified economy, right? If they blow up Southern Ontario real estate, fine. If they blow up real estate in Manhattan, look at, you've got Texas and Arizona's real estate markets on fire. That is a diversified economy. People are leaving California and New York and going to, El Paso, Texas, and everything is moving out of the coast into Texas and into Arizona. So there's pockets of growth. And let me be honest with you, and I mean this, in the United States, single family dwellings, you are in a secular bull market in the United States and in Canada because of demographics and the millennials, right? Right now, we could argue about real estate, about population. And here's the point I have with Ottawa, because I want to be, the weird thing about this, guys, is I'm trying to be objective. I don't want to be a bull. I want to be a bear. I'm just looking at the data. So going back to that previous point, we were talking about the decline in population growth in China. What Ottawa is doing in terms of immigration, right, makes total sense in terms of the long-term economic growth of this country, to basically, if we're not going to do it through birth, let's do it through immigration. That totally makes sense.
That is
But the
true.
point, it's not what they're doing, it's how they're doing it, right? And they basically, if you look at the immigration over the last couple of years, it's easy, right? Sustainable, right? So we've got rent going up in Canada, in Southern Ontario, because of all this immigration coming in. Hikes don't solve the problem, right? Hikes don't solve the problem, right? Which you go back to. So and the head of the Bank of Canada walks around, start the fire. Remember the Billy Joel song, right?
Yeah.
Right. We didn't. Fair enough, but you're putting gasoline on it. You should be cutting rates right now. You should be cutting rates to stimulate, because cutting interest rates stimulates a supply response, right? Banks would be lending. You guys could get money to basically build more houses, build more rental units. I mean, this singular undergraduate degree focus of the central banks only on demand and not supply, when they use interest rates and monetary policy, it's just a total, it's a total disappointment, because guys, this is like first year graduate school macro, right? This isn't PhD macro, this is master's level macro, right? This is to get your master's degree. And so I don't know why he's doing it. We can conjecture. What I am telling you is that eventually the math matters, and the rubber's going to meet the road. And until that happens, what I sit there and I say to folks, well, look, I mean, we can be denial up here, but I can tell you, talk to people around the world, and that's why they're shorting financials up in Canada. We had Muddy Waters come out shorting Fairfax today, right? I mean, this is just basic math. Now, you and I, because we're in Canada, can sit there and deny it, right? But that stick that doesn't fly in the city of London, in New York or Boston, right? They think we're crazy, right? They think Tiff Macklin should be cutting. He should be leading, right? He should be leading the Fed, right? Because this isn't cold fusion. It's in a textbook. You know what I mean?
So we all know that, hey, listen, if regardless of what Tiff McCallum might think, on, or either through ego, pride, name your adjective, he has to follow the Fed. So then, when do you feel, because we need to keep currency as relevant as possible relative to the US, when do you feel Jerome Powell, chair of the Fed, is going to cut, based on the remarks from about a week ago?
I think he cuts May, and I think the surprise will be he'll do 50 in May. And then he'll skip a meeting. He'll do 50 in July. And then he'll wait until after the election. And then they'll do another 50 in the end of the year, and we get 150 that way. And the thing we don't know, guys, and this is it, they should be cutting, and this, and it's a blessing and a disguise, right? I don't know if they've waited too long. Like, this goes back to my 06, when they, like, in 06, they started cutting really aggressively, right? And it didn't matter. I don't know if the damage has been done, and I'm trying to be honest with you, right? I don't know. I think and so I'm on the record, and I basically say, look, I think the United States is a dynamic economy. Artificial intelligence and blockchain and Bitcoin, and we're in the 90s again. That's my point, right? And I think we're in the 90s, and so we have the savings and loan crisis. That was the property crisis in the United States. Take out Tiff Macklin, put in John Crow. He basically attacked the real estate marketing in Ontario, right, to quell inflation, right? He waited too long. Real estate prices came down a little bit, but then traded sideways for a decade. And the reason why, I would suggest to you, like, I was out in Vancouver giving a keynote, 2,000 people, and I was just crushed afterwards, going to a mosh pit and just having people ask questions. Guys, everybody owns 3 or 4 properties. Everybody's long rental properties. Yeah. Right. And so I'm not saying it's right or wrong. This is what my job is. I communicate. Right. And so I think what's going to happen is real estate's going to trade sideways, and so that's fine. Right. And I think demographics are going to support and immigration is going to support. We're going to have a couple of tough years to readjust. I think we're going to have a shallow recession in Canada. Okay. I think the United States is going to be okay, maybe grow between 1% and 1.5%. Inflation is going to come down. They're going to they're going to cut rates aggressively once this thing gets done. So like in 25, late 25, we're looking at interest rates, overnight rates in Canada and the United States below 2%. And then let's evaluate it. Like, and I mean that honestly, as I get older, I say, I don't know a hell of a lot more. Right. And let's see what the damage is done. Maybe we're okay. Right. And maybe they have to raise rates up a little bit. Do you know what I mean? Maybe,
Well,
maybe they don't. Maybe zero's on the table. Right. But what I can tell you, what isn't on the table is the Fed having real Fed funds rates at 3.30 when inflation over 6 months is below their target. There is no political way Powell can pull that off. So 9 months, if you just, like I told you, if you look at the monthly data in 9 months, so he's going to wait. Maybe the problem is he's hurting cats on the board, right? Maybe he doesn't have a consensus, right? So if he waits until there's no meeting in April, right? And what he's just going to do is say, I'm tired of arguing with you guys. I'm going to let the data fall, right? And really, does it matter whether he does 25 in March or 50 in May? Not really, because the die's cast, right? Mm-hmm. We got to see what this thing looks like when interest rates get really down far. Like, there are commercial real estate properties in the United States that are going no bid right now. Like, it's that bad. Like this. And so that's why you hear me say, and the thing that just blows my doors off is how, Wall Street and Bay Street are doing exactly what they did just before the global financial crisis, right? Everything's fine. Everything's fine, right? We've learned nothing.
And so you're not, and for our listeners, like, and I've said this before, you hope you're wrong. Like, you're okay to be wrong, right? Like, you're giving us like, hey, if they don't do something, these are the consequences of their actions. And all Dr. J is saying is like, hey, I would rather be wrong. I'm okay to be wrong here. But based on the data that you're reading, you're tweeting, you're posting on LinkedIn, right. By all means, follow him on LinkedIn, Dr. James Thorne. It's a wild ride, what he posts. It's you're not saying you're not. I guess you don't want to be right in this situation, based on the picture that you're painting.
So I view, what I do is I look at you guys as a CEO. And I'm coming into the boardroom and I'm giving you the bull and bear case. You guys decide. But so what happens at Wellington, we at least talk about it. And if you get to a team, right, they can do whatever they want to. They can agree, they can disagree. But what I can tell you is we at least talk about it openly, right? And so, I hope, and so the fear of all of this is that, people think there's going to be time to get out. Right. And in my experience of being in the business since the 90s, we're penguins at the side of an iceberg. And we all jump into the water at the same time. Right. Look at New York Community Bank. The sell side still has buys on it. And that now it's down. It's been bombed. Right. Moody cuts it to junk. And then the sell side basically cuts after it's just been, it's been absolutely, the old Wile E. Coyote event happens to it. Well, I grew up on the buy side and we would just be freaking, right? Sitting there going, that doesn't help, right? So look, there's 4,000 regional banks in the United States, right? When Powell and the Fed took rates from zero. So let me go back. Let me just go back and say it's just a comedy of errors. I do not think that there is going to be a financial crisis like there was in 2008. And the reason was the nail in the coffin in 2008 is what we did is we all had cash in what were called near cash instruments. So they weren't cash or they weren't government bonds. They were like packaged products, and we got maybe 5 beeps more. Okay. And that's what we held on our balance. Corporations held on their balance sheets as cash. In the fall of 2008, we all came to the recognition that maybe the claims against these near cash instruments were greater than the instruments itself. In other words, we didn't know who owned what in cash. Okay. And the money market funds broke the buck. And it was the money market funds breaking the buck because of the derivatives that were written off of these near cash instruments. Okay. It was the settlement process that blew the system up. Okay. That's not going to happen. Okay. But here's the irony of it. Now, all these banks and all these institutions, they were told to own government bonds. Okay. Fair enough. So we're supposed to be safer. So what happens is, Powell basically, because of COVID, generates $4 or $5 trillion out of thin air and injects it into the banking industry. Okay. Nobody wants a loan. Okay. All of a sudden, you guys are running a bank, right? And you have, let's say, $1 million worth of deposits. But because Powell increases the amount of money into the system, you've got $10 million. $10 million worth of deposits. And Brandon picks up the phone and goes to Josh, who's the bond guy, saying, buy government bonds. You go and buy $10 million worth of government bonds at 0 interest rates. Okay. And you put them into the hold to maturity account on the bank. All right. Mm-hmm. Powell then guns the rates. Okay. Yep. Brandon, you are losing deposits which go to your tier 1 capital because the money market funds are at 5% and you're losing money because money in money market funds does not go towards your tier 1 capital. You phone up Josh and say, you know, those government bonds you bought like 2 years ago that are at held to maturity, sell them. Josh goes to Brandon and said, yeah, boss, but if I sell them, they're at 60 cents on the dollar.
Right.
Right. I break tier 1 capital. That's what happened last year. Okay.
That's right. That's exactly what happened last year.
And so think about this. They did this. Think about this. Okay. That bank lending funding program stops in March. And they want you to use the discount window. Well, to use the discount window, you have to have collateral. So Josh, you could have used the discount window in March of last year, but your collateral, you would have got 60 cents on the dollar, not 100 cents on the dollar, right? The whole regional banking system is vulnerable over the next couple of periods, right? They know this. They know this, right? So what's happening? And then where is all the exposure for commercial real estate? It's all in the regional banks, right? Because if you're funding a townhome development in State College, Pennsylvania, it's because people want to retire back at State College because they're Penn State alum and they want to go to the football games, right? And that's their jam, right? The local banks are financing that, not JP Morgan, right? So the commercial real estate market is manifested in the regional banking crisis. So, guys, we have a regional banking crisis coming towards us as we work through this year. Will it have major fundamental problems for JP Morgan or Goldman Sachs or the big bank, Bank of America? You know, some of them have to write some stuff down, but you've got a whole area that's vulnerable. And think about it. The Fed just came out a couple of months ago and ended the program, right? And it was a 1-year program. So Josh, that bond that you went to the Fed last March and you got 100 cents on the dollar, right? That's getting put back to you. And oh, by the way, the interest rates are higher today than they were in March of last year. So you're going to get that 10-year bond and maybe it's going to be worth 50 cents on the dollar, not 60 cents on the dollar. Brandon's going to sit there and go, oh my God, I've got to raise capital. Do you think, Brandon, the bank's going to be able to get capital? No. What's going to happen? Everybody's going to stand back.
Wait for the ship to sink.
Wait for the ship to sink. Rinse and repeat. That's what we're waiting for. So that's why you hear me talk about financial stability. And they know. So let me just be honestly clear. They know this. They know this. The Powell and the Fed were presented with a paper from the from the Kansas City Fed in July of 2022 saying, if you keep raising rates, this is what's going to happen. Okay? So don't ask me why they did it, right? I don't know why. The conclusions were known ahead of time. There are other motives, or maybe not. I don't know. Maybe they did make a mistake. I don't know. Right? Maybe there is some nefarious political reason. I don't think so. But you know what? I don't know. I don't know.
What so okay, couple things. I'm just Trevor. The next Bank of Canada meeting is March, end of March.
No, beginning of March, March 6th.
And is there a meeting for the Bank of Canada in April?
I think so. Is
April 10th. Yeah. So the meetings for the Bank of Canada this year are
nothing in May, I don't think.
24th. We got March 6th, April 10, June 5, July 24, September 4, October 23, and December 11. And the Fed is January 30, 31, March 19, 20, April, May 31. So the 30th of April, 1st of May, June 11, 12, July 30, 31, September 17, 18, November 6, 7, and then December 17th and 18th.
So, okay. Then that leads me to my next question, Dr. J. Just for everyone that may be not listening or watching us live, we don't know why. This is riveting stuff. We're on right now. It's February 8th, 2024. My sister's birthday, by the way, gentlemen. Okay, my sister's birthday.
Which one?
Happy birthday, Don.
Don.
Oh, happy
Don.
birthday, Don.
See, thanks, Trevor. See, he just knows. We have the S&P 500 closing in on 5,000 points. So then, can you put context to all your comments into which is a record that you did go on Bloomberg back in September, if I remember correctly, and said the S&P 500 was going to close over 4,800 points in and around. And I'm not quoting you verbatim, Dr. J. I just vividly remember that very passionate exchange. So put context then to why then is the S&P 500 closing in on a historical 5,000 point marker? And what's your
honestly,
call
I think there is faith, and I mean, so let's go back. Let me just say, so we're all clear that we went through and we exhausted the reason why they have to cut and reflate, right? Okay. And I think the financial markets in Washington, in New York City, have faith. Jay Powell is a private equity guy. He's not an economist. He's a lawyer. He's really smart. He doesn't have to do this job, right? He gets it. He understands the intricacies, and they're saying they're going to cut, and they are going to cut. I think that between what we're doing is it going to be March or April? I don't think it matters. And I think the profound thing that he did on that 60 minutes was he slipped in 50 beeps, right? And if he does 3 at 50, right? Remember they did 50s and 75s on the way up. We get down. So the guys, what I'm trying to say to you is they're going to do it. I wish they would do it earlier. We have to understand and be honest with the fact that if, as and when they cut down to 2%, or 2.5%, pick your number down there, right? It's going down. You still have to be honest with yourself saying that may not matter, right? But we're going there and we're going to reflate. And so when you reflate, and in my business, what happens is it's like I said, we're penguins, right? We follow the leader, right? when they sit there and go, they're going to reflate, you sit there and you open up the playbook, right? And this is no different, guys. If you go back from '08 on, every 4 years, we need to refinance the debt. And they have. They just take it to the abyss. Okay. So when they start to reflate and they cut and they expand the balance sheet and they increase money supply and they they'll come up with a program. It won't be QE. It'll be some other term, right? And they basically, for collateral, right? And they clean stuff up. The data is basically very strong, but basically says, here's what you own, right? You own the number one performing asset in reflation cycles since '08 is Bitcoin. The second is the NASDAQ 100, right? The third is the S&P 500. The fourth is the TSX, right? So so let's take the other shoe off. I'll put my happy pill in and I'm sitting there go, guys, they're going to cut. We are investors. We want to basically position our portfolios before they cut. They have to cut. He told us that he's going to cut before his 2%. We've just did the spreadsheet argument, right? Where we say and he said, as long as it just comes in just like this, it's going to be below 2 between May and June, right? It's going to be close to 2 in March. Okay. Well, if it's close to 2 in March and they pause and they do nothing in April and they do 50 in May, does it really matter? Right? Does it really matter? What it does do is it sends a strong signal that they're serious about reflating. Right. I am not in the camp that says that that inflation is going to miraculously, go back up. And so that's what's happening. That's why people are doing what I'm saying. Right. And then think about this. You cut rates, multiples in the S&P 500 and the NASDAQ 100 go up. You reflate. Right. You buy secular growth names because the economy is still decelerating, right? It's going to take at least 4 quarters, at least, for the cuts to kick in, right? Which means you've got a secular growth trade, right? Or the NASDAQ 100 trade until the middle of 25, right? And I think that's why you're saying, so coming into this year, so I come out and I say, look, they got to cut or we have this, and that's why they will. So I say 5,400 on the S&P this year and 6,000 next year. And I could be low.
Really?
Mm-hmm. Yeah. Yeah, because when in 1983 and 1984, when Powell claimed victory on inflation, the market went parabolic.
So then and then this is again for my clients and yours. I mean, you'll get these questions. Well, then if that's the case, if you're calling for doom and gloom, if you're calling for a mini recession in Canada or a big correction, then shouldn't the market the market react accordingly?
It did, but it is. But Brendan, it is. The NASDAQ 100 is beating the TSX by 7.5% in a month and a half.
Yeah.
The data, so when I come up here, I keep saying, guys, don't listen to me. Look at the data, right? This guy over here is scoring 50 goals a game, right? This guy over here is getting 1 goal. Why are you giving the guy the fourth liner? Why are you playing the fourth liner all day long, right? And so as we get further along in this, it's all emotion and psychology, right? Brandon, if you don't put your clients into the NASDAQ 100 and they do this again this year, you're going to have great calls if you're in this business. Basically,
you're right.
December, right? You're going to sit there and go, going back to the no low. Hey, dude, why am I paying you? Why am I paying you a fee when you've got me loaded in on Canada? Right? And guys, I go on the road. Everybody's still in Canada. Guys, nobody's there. Right? Yeah. Nobody's there. Nobody's got Bitcoin. Nobody's got NVIDIA. And if they do, it's small. It's small. Right? And so the point I'm making is this time it's not different. The reason why I'm emphatic about they have to, because if they will, they understand the risks. And the interesting thing is going to be is watch the subtle pivots in what Yellen says. She said about it. She talked about it today. Watch the subtle pivots in what's going to be coming out of the communication strategy out of Powell. He's already doing it, right? And so you know they know. So I go on the side of they're very cerebral. You cannot get to become the head of the Bank of Canada without being very smart. Okay. And so they understand this. I think there's some politics involved. They would never admit it. I think they're waiting. And I'll say this to you. If you really want my opinion, I think they're waiting to be late because they want to ensure that not that inflation goes to 2%, but inflation goes below 2%, which will allow them the air cover to get rates down below 2%. And so we can refinance all this debt, not at 5%, but at rates below 2%. We refinance it for a period of time, let's say between now and the end of 25. And then they start slowly jacking up rates after everybody's loaded in and refinance their mortgage. Right? Right?
So here's my question to that though, and that is 1/3 of CPI is housing.
Yes.
And you've got rough estimates. 55% of fixed rate mortgages are coming due towards the back half-ish, May, June 2024 to the end of 2025. What are your thoughts of, like, I like what you're hearing. I mean, I'm my fixed mortgage comes due in October. I've got some mortgage broker that's going to be working on it for me. Don't worry about it. It doesn't matter who that is. It doesn't matter who that is. Maybe his name's Rever. I don't know. But we've got a plan. Trevor and I have a plan on what we're going to do, and we talk about it quite often. But what about all those Canadians who don't? And just on my street alone, anecdotal, I've got 2 houses side by side up for over $1 million, and I know they're brand new houses, original owners. Oh, built 2 years ago, and I know what they built for. They're sitting. Like,
Yeah.
what are we? Like, what about 1/3 of CPI in Ontario specifically? That's derived by the housing market, and these houses all potentially lose because, big finance is gonna refi and do all that thing. Like, what are your thoughts on that?
All Tiff Macklin has to do is go to the chapter in Holland Taylor, which is the macro textbook, and say that you ignore policy-induced inflation. Tiff Macklin has the economic theory behind him to basically go out and say, we are no longer going to focus on this. We are going to take this area of inflation out, and we're going to start cutting rates. That's all he has to do. And then he brings rates down, and he brings rate down. We refinance, and the real estate market stabilizes. That's all he has to do. I mean, it's no different than the kabuki stuff that they've been talking about in their communication strategy over the last 2 years, saying that the economy is not slowing and they're not seeing interest rates coming down. Wages cause inflation. The economy's overheating. I mean, you can go through the kabuki stuff that they've talked about over the last 2 years. I mean, coming up with a reason why to cut rates with theoretical foundations wouldn't be a problem. They just have to do it. And I think knowing, and this is, so that's the weird position I get as a strategist, is I'm a classically trained economist, right? I have a PhD in economics and finance, right? I know what Tiff knows. So when you ask me what he's doing, I can go, there's no way he got a PhD, and there's no way he went, he was ahead of, he was at University of Toronto, and then he gets to the Bank of Canada. This guy's smart. Don't put the guy's a buffoon argument out the door. He's doing this for a particular reason. But what I'm just saying to you guys is, look, at all he has to do is change the page in the PowerPoint presentation and start cutting. And then the only question we got is when he cuts, what level does he go to, right? How fast, and what damage has been done? The statement of economic forecasts, right? Or projections, or the SEP. Remember, everybody talk about the dot plots in the States, right? Dot plots, dot plots. In there, it says that when core PCE is 2%, Fed funds rates is 2.5%, which means the real rate is 50 beeps, right?
Right.
By April and May, by June, let's say by July 4th, core PCE is going to be at 2% for 12 months. So all of this communication about we're not sure goes out the window. He doesn't have a political leg to stand on, and real rates are at 330. He can cut 150 and still be substantially over than what his long-term projections say that everybody anchors off of. And this is going to become a political nightmare for him, because as inflation anchors down and goes down, there is no reason to keep rates where they are. And he's not going, and he knows that. You can hear, when you listen to what he says in the Q&A, and you don't, the mistake I made is a buddy of mine phoned me up and said, listen to what the MSM guys are saying as Powell is speaking. And it's bizarre, right? When you listen to what he says, he's very clear. He's very transparent. He knows what he's talking about. He gets it, right? He really does. Now, does he wait? I would think, look, guys, I think they should have started cutting last year. I don't have a vote.
That was your
I
call.
don't have a vote. I don't have a vote. So whatever he did, he did. I can't complain, right? I mean, I communicate. I do my thing. I do my job. But for me, I mean, look what happened, right? I would go on to Bloomberg and basically say the argument for using labor costs as a reason why you are concerned about inflation is wrong. It's called the Phillips curve. I was treated like a piñata for 2 years for stating factual economic theory. What Bay Street pushes back. What happens now? They just go, oh yeah, you know what? Oh yeah,
Got a point there.
Wages lag inflation. Oh, okay, and they just scutter off.
Yeah.
Right, and you guys listen to them. Right, I don't say you guys, but
Yeah,
I know what you mean, the proverbial.
And so you're sitting there saying, well, how can they change? Guys, they justified rate hikes using kabuki theater. They should, okay, clear fact, simple point, economic theory. I don't even have to say it. Japan did not raise rates. Japan kept pumping. Where's inflation? Is inflation above or below 2% in Japan right now? It's below. They didn't need to raise rates. They misdiagnosed inflation. They own it. They're on the wrong side of history. They know it. They flinched. They lost their nerve. Okay? Now they're sitting there at 5% and they're trying to figure out what to do. They could cut by 150 basis points and still be too strong. And the folks on Bay Street are unwilling to call them out on it. And so at Wellington, because we are independent, we can at least talk objectively about the theory, what's going on, right? Last year, they were saying the economy was overheating, and it was 1 month, last January, because of seasonal adjustments. The rest of the year, look at the retail sales in this country are 4.5% below the long-term average. And you're telling me the economy's overheated, and right? Long-term real estate, retail sales, it's about 4.5%. And this goes back 30 years. This is what I do. And I just rip it down, go back, calculate an average on my, I'm not doing anything special.
Yeah.
Right? And you're here, and these guys come out and say the economy's overheating. Where?
Right.
Now, with respect to your
Beg your pardon?
With respect to your comment on the potential for real estate going sideways for a decade, how do you reconcile that with such a low supply chain here in Canada, particularly? Right? Like, I mean, it's
How much? So it's weird. You get old enough, you see these things a couple of times, right?
yeah.
So Josh, you have 8 rental properties. Maybe you should have 2.
Yeah.
And Josh, maybe you're not the only person in the country that's got 8 rental properties. And so what happens is the question I would put to you: how much demand has been pulled forward because people are owning too many rental properties? Now maybe they don't sell, right? If you can cash flow it. But that's what happened, dude. When I bought my first house, real estate went nowhere in the 90s, absolutely nowhere. But it still had all of the things, right? You had the bubble in the 80s. Crow came in and hammered it. We still had immigration. Like everything that you hear about today existed in the 90s. Okay.
Mm-hmm.
And so the point I would make to you, yes, interest rates were a little bit higher, right? I get it. And
A
the
little bit. You're
argument
being
would be is,
facetious,
could they
but
get rates? Could they get rates to a level? I think they're going to go, and I don't know anything. Could they get rates down? Look, I think between now and 25, they're going to overshoot to the downside. And then in 26, 27, they're going to come back up to a level. And that level is going to find a nice equilibrium. And guys, and here's the thing: I think the central banks are going to be okay with a little bit of animal spirits in risk assets to counteract these economic growth slowing in real factors, right? I think it would be okay. I think the Bank of Canada understands the precarious positions of some of the financial institutions in this country. I think there is a knowledge. I don't think they don't know what they're doing. I think they have the data. They're basically playing a political game.
they're playing chicken almost right now is what it sounds like. Right?
Jay Powell was out on 60 Minutes saying the financial situation in the United States is non-sustainable. You had Janet Yellen doing that. All they got to do is pull back on fiscal policy and the economic growth slows. Mm-hmm. Right. But to the point that I want to make, guys, is look at if the Tiff Macklin is absolutely wrong if he thinks that keeping rates high is going to solve that immigration problem that the prime minister did. Right. And all I'm saying is all I'm trying to say is, look, I get population growth for the long term, and I write about it. I think medium term population growth is great. So let me just not say I'm not arguing about the policy. Right. I am arguing about the implementation of the policy. I wish the policy was implemented in a non-inflationary way, right? Yeah, I wish there was more thought behind it, right? So, and that's the whole point. I said, I say about the carbon tax too, right? So I am not arguing about look, we live in a democracy, blah blah blah. What I argue about and what I push back on is not the policy, but I want the policy to be implemented in a non-inflationary way. And if society thinks that greenhouse gases and we need to do these things and we elect, even if I think personally I'm against it, but that's the price that we got to pay when we live in a democracy. Is that
right?
You get my drift? I just wish it would be applied in a non-inflationary way. That's all.
Their ideas are good a lot of times, but I agree with you. Most of the time, the bank, the way they roll things out is absolute shit.
It's bizarro, right? So that's why, that's where I have a problem and that's why when I write stuff about, I steal a quote from Shakespeare saying there's something rotten here in Canada, right? I just don't understand why Macklin interprets the policies implemented by the Trudeau government as inflation created by the private sector. Because if he was thoughtful, he would basically, he would know that inflation spike that's being caused by Trudeau and the NDP, rightly or wrongly, it doesn't get solved You know, what are we going to do? Like raising rates is going to force us to kick out half the people we let in. I mean, how do high rates, get rid of the rental crisis? Like, tell me what? No. And then all of a sudden, wait a minute, these people are paying more, right? Which means
Trudeau's got to go
going to housing than it is for spending stuff. Like, help me out here. How spending more money on housing is inflationary, right? And that's why the Americans took housing out of inflation.
100%.
100%, right? And so I just don't see how, if Powell starts cutting, and he is going to cut, and if he says 3, fine. I still think he knows he's cerebral, and he knows he's way too, you can hear it, right? You can hear it from really, really smart people in Wall Street saying that something has to get done. They're going to cut. And the only reason I push back on that, guys, is, it's a bias, and because I lived through, the last financial crisis. Pardon me. When they cut in the last crisis, it didn't matter. It didn't matter. And I'm just trying to be honest. Like, I hope it matters, right? I hope it matters. Hope
it's not too late.
Hope it's not too late. Yeah. But if we were on a trading desk in New York City and Wall Street, you know what the trader would say to us? Hopes are short. Hopes are short.
Mm-hmm. I've always predicted that it'll be Q2 by the time they drop the rates. For some reason, that's where I saw them.
That's what I say in writing, right? I was hoping March would be historically consistent, right? Yeah. I do not see why they should. I mean, but listen to what he said, though. As of last meeting, March would not be a rate. He qualified it. As of last meeting. Well, what happens if he gets 2 or 3 inflation print? Like, so you're sitting there, you guys, you're the head of the FOMC. You're a pal. You get 2 more months of data. Right now, you've got 8 months of core PCE that's, tracking at, 1.6, 1.7. And you run it. What would you do? Would you sit there and not start cutting? Or would you basically say, I'm going to wait till May because there's no meeting in April, right? And then if you are going to do that, which is a good chance, then if he does that and the data keeps falling as we think it is, which is the premise of my argument, right? The facts change, you change your argument, right? Or in your conclusion. Then I honestly think he's going to be way too late in May and he's going to cut 50. And then the question is does Macklin follow, or does Macklin start?
Macklin Macklin's going to have to follow. Macklin will have to follow at that case. Logic, but that doesn't.
I agree. And so when that happens, we get a soft landing in the United States, right? I am saying we have to chop through some wood up here, because we are much more exposed to real estate. And 2, Ottawa has deemed energy not to be a non-growth sector, right? And what the heck else do we have up here? Like, I'm sorry, guys. I'm sorry. And then you sit there and go, why don't I like the TSX? I sit there and I go, 31% banks and 20% energy. I mean, given what we're talking about, do you want to buy an index that's basically 30 banks, 50 oil? Right? And where you go over here and you go to the NASDAQ 100 that's got Costco and Starbucks, got a little bit of oil, got some Chevron.
Yeah, diversified, right?
It's more diversified.
More diversified, and it's got way more tech. Whereas in Canada, which is different in the 90s, here's a different thing, guys, from the 90s. In the 90s, when we built so we are in front of a generational, so let me be bullish. We are in front of a secular bull market to the end of the decade, okay? The innovation and the productivity growth that we're going to see because of AI and blockchain and Bitcoin and crypto is going to be bigger than what we experienced in the 1990s. The problem with Canada is that in the 1990s, we had Nortel, we had Bell Canada, we had JDS Unified, we had Newbridge Networks, we had Research in Motion. We were at the forefront of building out the internet. We have no horse in the race this time. We've got the TSX has 7% of, I think 6 to 7% tech, and that's Shopify. So if we're in front,
Yes.
like so, and we can invest anywhere in the world, right? You guys, us five, we can anywhere in the world, and we're in front of a generational tech wave, right? Why would we want to invite? And I'm not saying I can't. Why would you vote? Why would you invest in the TSX? Right? Where do you go? You go to the United States. Why? They've got it all. Right? You can buy and you sit there and go, you can buy the S&P 500. Why not buy the NASDAQ 100? You got to bet it's better. It's higher quality. Right? And in our business, risk is perverse. Right? We think that old is less risk than new. Right? Michael Milken and junk bonds proved it. No, risk is perverse. We want to buy a tech. So you're telling me buying a company that's well positioned for the future has more risk than a company that has yet to evolve that's living in the analog world? Really? Really?
Yeah.
Right? So we go. Right? But here, let me be clear. I think energy names are great. I think they're returning a ton of capital. Right? They're great. But let me be honest. I worked in the States for like over 20 years, right? The Americans don't buy energy. Americans don't buy commodities. Right? They'll buy Exxon and say we've got exposure. Right? Right? They'll say they'll buy and they'll buy an energy, like they'll buy Cameco. Like uranium's great, right? They'll buy that. They'll buy Cameco and they'll buy Exxon and say, I got exposure. Yeah, see you later. How's that meta doing? Right? And everybody freaks at me, and all I'm saying is, dude, leave Burlington or Oakville for a day and go down to New York City and talk to somebody that's allocating size capital.
Fair.
Well, Dr. J, it's always a pleasure.
Certainly
Can we
is.
have you on? Can we have you on again?
Sure. Hey guys, you guys got to look at Bitcoin.
Don't say that to Curry. Curry's going to lose his mind.
You guys look at you've got mainstream adoption, 1, and 2, you're in front of a halving cycle. 2 and 3, every time they reflate, the thing goes. So if you can't get your brain about it now, this is what I'm saying. This is a time you need to educate yourself. I am not saying it's not for everybody. Do you hear me? Right? But you need to educate yourself now, because if it plays out the way it does in history, right, it's going to be substantially higher and you're going to miss the move. And that's okay, right? But don't buy it at the top if you don't understand how volatile it is. But everything is pointing to a parabolic move in that asset class over the next 18 to 24 months. So if you can't get your head about it now, please don't buy it in the middle of 25. Okay, guys? That's my point. It's not for everybody, right? Educate yourself.
Okay.
It's a good takeaway, Doc.
Cheers, guys.
All right. Thanks, Bondo.
Help us help you stay informed. Out.